Bean, you loved watching one of my videos that talks about using a HELOC to fund the whole life, then borrow out of the whole life to pay back the HELOC and do it again. How often can you do it? Thanks. Thank you. That is something you can do every single year. The idea is you're going to end up paying back the HELOC, and you're going to eventually pay back the loans in the life insurance. Like that's got to be the plan in there somewhere. We can't just borrow forever because it ends up getting expensive. Now we're going to be getting growth, compounding growth in the whole life, but we don't want the interest to be compounding in there on the loans that we're borrowing. So what I do that thing. I fund my whole life policy and I borrow out of it in order to pay back or invest in wherever else I would rather have that money. If I'm doing it with a HELOC, which I did last year, funded it with my HELOC, borrowed it out, paid the HELOC back. Okay, I still make sure that I can pay for the interest costs on that loan. So it's not compounding, but my growth is going to compound. Okay, so that's one of the keys. And as long as I'm doing that, I could do that forever. If I'm paying that, and at some point, I don't have to keep paying the interest costs either, because I'm getting separation with a compounding growth, and I'm not getting the costs compounding. So I'm growing. And a couple of years down the road, I'm going to hit my break even, where I'm going to have more money available to me in the policy than I paid into it. And at that point, I'll have the growth that's happening in the policy will be able to pay that interest cost each year. That's my hope, is that the growth, the dividends I'm getting is going to be able to pay that interest cost each year. So I won't have to pay as much of it. I figure I'll have to pay some of it, but the amount that I'm going to pay on it gets lower and lower each year. And then at some point, I'm done max funding those policies and I'm going to start knocking off the loans. But in the meantime, I'm in my growth phase. Not everybody's in their growth phase, so it might be a different situation for folks. I'm in my growth phase. I'm putting this money to work for me. So I'm investing it. I'm funneling it into my life insurance policies so I can get that death benefit just in case something happens to me. But I'm also taking it out and I'm investing it to get faster growth. And with that growth, I'm going to use that to pay back those loans. So it's not for everybody. That's just what I'm doing. And I like people to have the idea of what they could possibly do. Okay? But you got to have some good income. You got to have some good cash flow to be able to do that. You can't just get $100,000 in life insurance premiums and not have any cash flow to be able to cover the interest costs. Because these interest costs are going to add up. They're definitely going to add up if I'm continuing to take loans out. Okay? So using a HELOC to fund your life insurance policy, whether it's whole life or IUL, it's awesome. I love it. We got to make sure we're practicing our dynamic banking, though, to keep that average daily balance down. Pay that back so you can do it again the next year. And hopefully you pay that back and you're able to throw a chunk at the loan in the life insurance policy so that you can bring that down a little bit. That way, in the next year, when you go to pay back in from the HELOC, you're not maxed out on loans in your life insurance policy. You always want to leave a little bit of room in there. It's always best to be safe. Okay? Being, do you have a calculator to measure how much to use HELOC to fund the whole life to make sure you don't overdo it? Some experts say 70-30 split versus 90-10 split. Can you explain what that is? That does not have to do with the HELOC funding. And I have a number of videos talking about the different splits and why I go with the 90-10 split. When this gets cut up into some other smaller videos, the link is going to be put right up here. You're not going to see it now because we're live. But the link is going to be right up here to some of those videos. Check those out. I recommend you go to my channel and check out the videos that I have. I probably have 10 of them that I've done on the different splits. The risks associated with it, the benefits associated with it, most everything you can think of. So definitely check that out. And if you have a specific question after watching those, come back and ask me, because I'm not going to be able to get into as much detail during this live stream as I've done over the course of all of those videos. A lot of good information to look at and consider on those videos. As far as a calculator to measure how much to use the HELOC to fund the whole life, I don't have a calculator. In fact, I don't think you need a calculator. The main thing is if your HELOC is a higher interest rate than your loan in your policy, you're going to, or in anything that you're trying to pay it off, you're going to want to you're going to want to take chunks out of it to fund your whole life, or chunks out of it to pay down your mortgage or whatever. You're going to want to do smaller chunks. So if it's a high interest rate, you're going to do smaller chunks. Because the idea behind using a HELOC is we're going to funnel our income into it. We're going to do our dynamic banking, and we're going to knock down that average daily balance. If we have a 10% interest rate in our line of credit, we don't want to leave a big balance in there, because we're going to knock down some of it, but we're not going to be able to knock down all of it with our income. If it's a nice low interest rate, you can use more of it. We always want to leave some to help cover any emergency costs that we might run into. Okay? So if you do, I would probably recommend not doing more than 80% of whatever the value is. Okay? And getting up to 80%, like, that's pretty aggressive. And I would do that if you're knocking down debt that has a much higher interest rate. Like if you got credit card debt that you're paying 18% or more in, I would borrow out maybe the whole thing out of the HELOC, not get rid of that credit card debt. Because a credit card you can use for ongoing monthly expenses. You know, I mean, it can help you to maximize your practice of dynamic banking with the HELOC. Okay, if you're just funding your policy, I would probably do a series of transfers just so that you know you're going to know your overall finances. But you don't want to be in a situation where you've maxed out your HELOC and now you're in financial difficulty somewhere else, and you would have liked to have that money. Now, if you're using it to fund your policy, you're going to have that cash value available in your policy if it's designed well. So I'm not too worried about using too much to fund your policy, because you can just pull it right back out, pay down the HELOC. But if you're doing anything else with it, you got to watch how much of that HELOC that you're using, because you definitely want to have liquid funds available to cover any type of emergency expenses. Now, one of the things to consider, if you're going to be using a HELOC, you're going to be doing dynamic banking, there is a chance that you could lose access to the credit in your HELOC. And the worst time for that to happen would be right after you throw your income into it to bring that balance down. And then suddenly the bank says, oh, you know what? We're reducing your credit line. In order to make sure that that doesn't happen to you, you want to kind of pay attention to what's going on in the market. You want to make sure if the stock market's dropping, if regulations on banks are increasing, their liquidity is drying up, those are all signs that maybe, or if the real estate market drops, that maybe they're going to limit your ability to continue borrowing out the same amount you had been. They're going to reduce your credit limit available. You don't want that to happen if you're doing dynamic banking in your HELOC. So if you're paying attention, you start to see some signs that, you might have to worry about that a little bit. In that case, just borrow everything out of the HELOC. Take it all out. It's worth it to pay the interest for a month or two or 6 or a year while you're waiting it out to see how's everything going to shake out. Because I'll tell you what, if the market crashes, if the economy goes to crap, if you lose your job, if you lose your income, your ability to earn an income, you're going to be really glad that you had access to that equity and that you took it out. You're going to be in a world of hurt if any of those things happen and the bank limits your access to the equity in your home. If you've been paying on that home, you've been building up equity in it, and now you can't access it because you can't qualify for a loan. Banks aren't giving it. You lost your job maybe. You just don't have the income to support it. That happens. It happens all the time. Not that the credit limit's reduced, but that people encounter an emergency, and oftentimes that financial emergency is caused by a job loss or the economy dropping. And they don't have access to money because banks love to lend money to people that don't need it. But the people that desperately need it, they don't like to give them any money at all because their ability to repay is very limited. So take that into consideration. Be careful out there. Hope that helps.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.